Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and today we're sitting in lovely Cafayate, Argentina. I have our guest for the day is Frank Trotter. He's the Executive Vice President of Jacksonville-based Everbank. Frank, welcome on the program.
Oh, love to be here. Thanks so much for having me.
Frank, we've met several times down here in Cafayate. I'm not sure why I haven't had you on the show yet, but thank you for taking the time today. Yesterday, November 5th, you participated in a small KC conference held here in Cafayate where you spoke about the market outlook, potential election implications, and inflation. I thought it'd be a good idea to copy many of the questions presented to you by Nick Giambruno of the International Man, who moderated the conference, and share your thoughts with our audience members. Let's start out because we're going to put this out on Monday and the elections are on Tuesday. We'll stay away from the politics, but you're a banker, so I want to get your feeling on, first of all, how has the market been pricing in who's going to win? Is it Trump or Hillary?
You know, I think the way the market's looking at it right now is it's pricing in a Clinton win. I think the best evidence of that was a couple weeks ago when there was a bump in the polls, some of the issues with the emails, and all of a sudden there was a kind of a flash crash. Of course, it corrected itself pretty quickly, but I think that's what the market's pricing at this point in time. Time will tell if that's what really happened, and we'll be interested to see. We'll be on the plane on Tuesday night, and we'll wake up Wednesday morning, hopefully, with a result.
Let's talk about the implications, once again, from a banker's standpoint, on what you think the market will do if Hillary wins or if Trump wins. I would imagine if Hillary wins, there might be much of the same policies already in place under Obama. If Trump wins, maybe there's some uncertainty would be the best way to explain things.
You know, market participants love certainty. I think if you looked at the way Brexit occurred, it was unexpected, and people really just didn't have that built into their investment models. You know, there's a bit of a crash for a few days, and then everybody got their model put back together, and boom, it was right back where it was. Everything except, of course, the pound. You know, I think, as you mentioned, I think our view is that if Clinton wins, it's likely to be similar policies. We expect a deadlocked Congress. They've already pretty much announced to say that if the Republicans control the House, which is likely, that they don't intend to work with the president. And if they control the Senate, so much the same thing. I understand the Senate's a bit of a jump ball at this point in time. You know, on the other hand, with if it becomes President Trump, then I think there's a lot of uncertainty as to what the actual policies are. You know, the markets like free trade, the markets like certainty, and so it'll take a little time and a little more precision in what the actual proposals will be to really get a handle on where that's going to go.
Frank, continuing on the note of policy, let's talk about the Fed. You made some interesting, observations about Fed policy. First of all, the market is certainly priced in the fact that there's going to be this next hike. Whether that hike is significant or not enough to matter, I don't know. But what do you think that the Fed's going to do, and what do you think that they should do from a market perspective?
Well, I think that it's, as you mentioned, it's highly likely. I think the market has north of a 75% chance of a Fed rate hike in December already priced in. And at the same time, you know, it's a quarter point. It's not like it's a 2% rise. It's not like it's a 1% rise or any move much larger than that. As a result, you know, I think that, you know, there may be some little bit of a dollar rise around that time. It may indicate to the rest of the market that things are a little rosier than perhaps the market sees. But in the end of the day, it's unlikely to have a huge impact. You know, what should the Fed do? Yeah, my view, certainly personally, is that it really should get out of the business of setting these interest rates. There is certainly a function of liquidity that a Fed can entertain, but I think the interest rate policy has really gotten to be a little odd.
The Fed certainly dug itself quite a hole in that if we have another market crash like we had in 2008, it's questionable if the Fed has enough ammunition to continue what they've done over the past 8 years to resolve a market crash. I just read Jim Rickard's book, which isn't out yet, but we just interviewed him on the show, and I don't know if you've gotten a chance to see it, Frank, but basically he says that the reaction this time is going to have to be different. They don't have the ammunition, and instead they're going to kind of shut everything down and prevent trades from going through, prevent the market from crashing, essentially. There was in 1914, the New York Stock Exchange was shut down for 4 months. He uses that as an example. I just want to get your feeling on maybe not predicting if there's a market crash, but if there is one, what you think would happen.
Well, everything, of course, depends on the scale. If it's even something like 2008, possibly the Fed has enough ammunition, to provide the additional liquidity into the market. They put round numbers, $4 trillion onto their monetary base, into their balance sheet over the last 8 years, and I don't think there's a reason that they couldn't put another 4 if they had to do that. If it's a crash to some ridiculously low number, I think all bets are off in a lot of different ways. What caused it? What was the trigger? Was it a large financial institution? Was it something else completely that set the whole thing off? And in terms of shutting it down, no real opinion there. I think that's certainly an option if they feel they have to do it. I do note that the U.S. Fed, at least today, is precluded by law from buying equities as opposed to the Japanese central bank. I think if you asked a voting member of the Fed, which I've done, what they would do in either a recession or even something more significant, and the answer pretty much is that we would buy more bonds.
Yesterday, you gave one of the best and easiest explanations for why inflation has not crept into the situation that badly. Gold bugs will make the argument that the Fed has printed all of this money, and the numbers that are reported showing 2 or 3% annual inflation are simply false. You didn't really make a statement on whether you thought those were accurate or not, but you did have a mathematical reason why they're coming up with that number. I thought it was interesting.
No, that's right, Colin. There's a couple different types of money, and we have to go back to our textbooks and let me be a little wonky here for a minute. But there's state money, which is the money that the Fed provides to the system, and then there's bank money, which banks provide through the fractional banking system. And if you add those two together, they ultimately become the money supply. Let's use M4 just to be, you can go look it up if you want to, but it's a good one to use as a measure. In 2008, the Fed was about 5% of M4. In the intervening 8 years, they've added to the monetary base significantly, primarily by buying bonds, selling bonds into the market. Since 2008, the Fed has moved from about 5% of M4 to about 19% of that same number, mostly by buying bonds in the market and providing liquidity. At the same time, bank money, which is the largest portion of any money supply, has been going down. It's down about $1.5 trillion over that same period of time. So the total money supply has grown, but it's grown at a compounded rate of about 1.7%. Well, not completely uncoincidentally, the inflation rate today, as measured and reported, is about 1.7%. And if the banks had lent at a pace that might have occurred in the early 2000s and the 1990s or the 1980s, we probably would have hyperinflation. But as it stands, the banks have not been able to put that money out the door or are disinclined to put that money out the door. And as a result, mathematically, it just can't happen.
Frank, that begs the question then, with the current Fed policy, what would it take to drive a situation where we see inflation? Is inflation or some type of hyperinflation baked into the cake, but we just have to see how long it takes to play out?
Yeah, I think baseline inflation will continue, as reported, to pick up a little bit, but it won't be spectacularly out of control. To get hyperinflation, it really does involve more lending from the private sector. Banks becoming more confident in businesses and putting money out the door, becoming more confident in individuals and putting money back in mortgages or other personal loans. There's been some debt growth over the last 8 years, but frankly, it's not significant. There has been debt growth at the governmental level that is substantial. And is it a crowding out effect that may be tamping down some of this inflation? It's possible. But I think to get a hyperinflation, we really have to get the bank money going. And that's just, we don't really see that as a likely outcome today.
Jumping over to currencies then, do you think that the U.S. dollar is a relatively strong currency? Is it something that you would keep at least a decent amount of your capital in?
Well, obviously part of that's based on where you buy your food. To the extent that you need a return in a currency where your inflation rate probably should be matched by the investments you make, you probably should keep some money in dollars. Our view, and I've certainly talked at length to Chuck Butler and to Chris Gaffney, both on our team, is that we think that the U.S. dollar's strong trend is likely at or very close to an end. We do expect that if the Fed raises rates in December, that we'll get a little bit of a bump up. But beyond that, we think that the dollar will now start to trend downward against most of the major currencies. Just take as an example, the euro, and we all know that Europe's in pretty big trouble in a lot of different areas. The euro hasn't gone from 107, 108 where it was at the beginning of the year to 100 or 95. Instead, it's bumped up into the 116s and sort of sits at the 110, 111 level right now. And I think what that suggests is people are done using the dollar as a safe haven and are probably going to start investing in other currencies.
Frank, Everbank is a very unique bank in that customers in the U.S. can open currencies that are not just the U.S. dollar. They can hold other currencies, several around the world. Begs the question from your last answer there, what are your least and most favorite currencies? Forget the ones, the oddball ones in Africa, but of the main currencies, what are your least and most favorite?
I think what we feel is that the commodity currencies, the Australias, the Canadas, and so on, that are really most likely to have the best returns. We've liked Norway for many, many years, and it's been sort of a middle of the road performer. But if you feel as an investor, perhaps, that oil prices are going to rise, and I know that's kind of a jump ball for a lot of people, then some place like Norway gets interesting as well. On the least favorite side, Euro's probably going to do okay, but probably would be something I would stay away from. We like Singapore, and China right now I think is probably going to be in a 4 or 5 year period of decline. There's a lot of trouble and woe that seems to be reported under the table there. It's a little hard to get the same numbers out of the official statistics. And as a result, we're probably less excited there. And the only other place that isn't strictly a commodity currency we do like is the New Zealand dollar. It's a different economy. It's out of the mainstream. It doesn't have the terrorist issues that most of the rest of the world has. And many of the things that they produce there are in demand. And as a result, we think it might well be strong over the next few years.
Based on that answer, it sounds like the commodity downtrend coming to an end in your perspective. Is this just looking at the charts and seeing that a new trend is starting to form, or is there some reason that you think the commodities having gone down for 5-6 years in a row are finally going to go back up?
Well, I think, as so many people in the biz use the phrase, there's nothing that cures low prices like low prices. Both you're going to get a little bit of a production cutback, and people are more interested. I can make a lot more interesting profit if I have a lower price of copper or tin or oil or anything else. And so maybe I'm going to start buying it again. We think it's a little bit of a supply contraction, a little bit of a demand increase. And we do feel that after 5 years, down 95%, and let's say the junior golds, that's likely to start turning around. And those countries that produce things that people are going to want, even if it's a small bump up in price, are going to be the ones, the commodity currencies, that are likely to improve over that next 3 to 5 years.
A lot has been made of Deutsche Bank and the trouble that they're having in Germany. The last thing that the world needs right now is another Bear Stearns situation like we had in 2008. You brought up this concept of liquidity being a problem only when liquidity is a problem. How does that play in with the situation with Deutsche Bank?
Well, I suspect, I haven't, don't run all the deep analysis on Deutsche Bank, but certainly some of our team has. And our view is that at the current capital levels, the current earnings levels, and so on, that they're likely to come out of this on the other side. However, the phrase that we use is liquidity only matters when it's the only thing that matters. And at the end of the day, you have to have enough cash in the bank to make wires. If your trading partners start backing away from you, that's what causes Bear Stearns to go down. That's what put Lehman behind the eight ball. It's also what hurt AIG, although they certainly had more capital losses than I think Deutsche Bank's likely to have had. So it's really more a matter, will the world keep trading with them? We've certainly heard news stories of hedge funds pulling out. A few other banks are reducing their lines. But to date, I think that's been maintained. And despite Merkel's rather bad attitude, or whatever, it's not a bad attitude, it's just her attitude that we're not going to bail out any of those Greek or Italian or Spanish or Portuguese or Irish banks, I bet when it comes to Deutsche Bank, they'll get a little bit of a boost from the government as well. So, yeah, we don't think it's all rosy. We do think there's a possibility that there's a significant event, but right now we're playing it as probably over 50% going to be there this time next year.
Frank, there's been the emergence of negative rate bonds being issued around the world. This wasn't really a thing as of 18 months ago, and now I understand from the last number I saw that there's over $15 trillion of negative rate bonds, and it's on its way up to $30 trillion. Does this mean anything? What do you think the implications are? What are the effects going to be from negative rates?
Negative rates really are going to be an enigma for a little while. The finance models have not introduced the concept of imaginary numbers like the mathematicians have. And, almost any model you put it into, it doesn't really work. So it's going to take the world a little time to adjust. I'm not even sure if a U.S. bank can legally pay a negative rate. We can always charge a fee, call it whatever we want, I suppose, but it's not even built into the regulations as far as I know. And I think it indicates that we really are in a bit of a razor's edge here. We all feel perhaps that the Fed policy and so on might produce hyperinflation, but there is that possibility we tip over the other way. Negative rates imply negative inflation, and that's a pretty unusual situation in the modern world. We really haven't seen that since the 30s in a big way. And I don't think people have a method to deal with it. Personally, I like it when my money's worth a little bit more than it was yesterday. I can buy a few more things in a deflationary period, but that's very hard to run an economy. And with so much government debt out there, that depends on an inflationary environment to pay it off down the road or service it. So I think an extended period of negative rates really could be a very bad thing for the global economy. Fortunately, we haven't quite hit it here in the States. Looks like we're about to raise rates at the Fed level in December, so hopefully we avoid it completely, but it's going to be a real problem if it's going to be a global issue.
Frank, gold can be considered a currency, and it's something that you've touched on a bit, that the commodity downtrend is likely coming to an end, but gold and silver as an extension are an asset class on their own. They're the precious metals, of course, and they're tied in very much so with monetary policy. Do you think that gold is on the up and up, and do you see something playing out like the likes of Doug Casey, where gold's going to really outperform everything over the next few years?
Well, it's been a period of time since 2000, 2002, where gold and silver have outperformed really most asset classes, unless you get down into the really fine details of some of the smaller ones. Is that going to continue? I think it's reasonably likely, particularly in a low-rate interest environment. That old argument about the cost of holding gold, where it pays no interest and in fact costs money to store it, pretty much goes away. So you have some interesting math that starts you off at the beginning of the day. And at the same time, I do think its appeal has broadened again. It's not like the 1930s and the 1920s when pretty much everybody had gold, knew the price, knew how much it was worth, knew how much it could buy in the market. But more and more people are participating in the gold market. And of course, there's India and China, of course, has been written about more than I need to talk about here. And as a result, we think that gold is likely to firm up over the next few years. Is it going to go to the moon overnight? Probably not, unless there's some crisis that drives it there. But we also don't see it falling like some commentators do to some ridiculously low levels.
And let's end with the last currency, a new entrance on the space. Bitcoin, of course, you talked about this yesterday at the conference, and I want to get your opinion on Bitcoin and maybe some of the benefits or downsides you see, and if it's going to last.
It's interesting. Bitcoin is a currency, and it does have a value. I think at some point it actually gets to the arbitrage value and settles down in terms of volatility. At the end of the day, it costs X dollars to produce this using a certain amount of computing power, and that's pretty much calculatable. And if the price goes below that, nobody's going to try to produce anymore. Ultimately, that reduces the supply, and the price goes back up. I think that it will continue to grow a bit. I don't think it will, in the short term, become a dominant player in any way, but we do have an interest in the blockchain protocol for transferring money. We're starting to see a load of fintechs out there who are using it to build different things, ranging from internal corporate payment systems to actual payment systems across borders. And in some cases, they're also trying to work their way around the wire network, the SWIFT network, and so on. And I think there's some real hope there. Sort of on a protocol basis. I kind of view the Bitcoin protocol as more the VHS, where eCash is the beta. Beta didn't win, and maybe eCash ultimately doesn't win. But VHS certainly did great until CDs came out and then the digital music. So there's more to come. People are going to be creative when it comes to money. And just like we say for those of us who have basements, water will find a way. The market will find a way to make money transferable seamlessly and effortlessly down the road.
Frank, thanks for coming on the program. For listeners interested in finding out more about yourself, getting in contact with your team or Everbank, where can they go?
Easy answer for that. We're, of course, at www.everbank.com. And there's phone numbers and websites and contact information all over that website. We're happy to put those numbers out there, and we hope you call. We don't hide them like some of our other friends do. So looking forward to talking to you down the road, and sure appreciate the time you've given me today.
Thanks so much, Frank.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen, or are you too stupid?